The US Treasury quietly made a move that most people missed, and that silence is exactly the point. Over the past several weeks, the Federal Reserve has stepped into the Treasury market and absorbed a massive amount of short-term government debt. On the surface, it looks routine. Just another technical adjustment, another behind-the-scenes operation meant to keep markets functioning. That's the story being sold. And Wall Street is more than happy to repeat it. We're told this activity is stabilizing mortgage rates, calming funding markets, and preventing unnecessary volatility. Everything is under control, nothing to worry about. But when central banks start stepping in as buyers of last resort, history tells us something very different is happening. Because this exact behavior has appeared again and again, right before currencies weaken and confidence breaks. What matters here is not the headline number itself. What matters is why the Federal Reserve had to step in at all. A truly healthy market does not require constant intervention. A system built on genuine demand doesn't need emergency liquidity injections disguised as technical operations. Yet here we are. For years, the Federal Reserve promised it would reverse its crisis-era policies. It told markets it would shrink its balance sheet, unwind excess liquidity, and normalize the system after the emergency measures of the last decade. And for a while it did. The balance sheet came down from extreme levels. Officials celebrated it as proof of control. Then something broke. As soon as liquidity was pulled back too far, pressure began appearing everywhere. Funding markets tightened. Volatility crept in. Stress fractures formed beneath the surface. The system revealed how dependent it had become on constant support. And the moment that dependence became obvious, the tightening quietly stopped. Now the balance sheet is expanding again, but from a much higher starting point than any previous cycle. That detail changes everything. In past crises, central bank intervention started from relatively low levels. Today, intervention begins on top of trillions already injected into the system. That means every additional dollar carries more risk, not less. The margin for error is gone. Officials insist this is not monetary easing. They emphasize that these are short-term instruments, not long-dated bonds. They stress technical definitions, accounting labels, and procedural language. But definitions don't change outcomes. If a central bank is supporting government financing because the market cannot absorb it on its own, that is intervention, no matter what name you give it. And when intervention becomes permanent, the system is no longer freestanding. Think of it this way. If someone is juggling debt by moving balances between accounts, the problem isn't solved, it's postponed. The total obligation doesn't disappear, it grows. And the longer the process continues, the harder it becomes to stop without collapse. That's the situation the Treasury market is drifting toward now. Over the next short period of time, trillions of dollars in U.S. government debt must be refinanced, not issued for new projects, refinanced just to keep the system running. And on top of that, additional borrowing is required to cover ongoing deficits. The total amount the market must absorb is enormous, and the buyer base is shrinking. Foreign demand is no longer what it once was. Several major holders have been steadily reducing exposure, not increasing it. Domestic institutions are constrained. Banks face capital requirements. Funds demand higher yields. Every natural buyer wants compensation for risk. That leaves one entity capable of stepping in at scale, the central bank. But when the central bank becomes the buyer of last resort, the consequences shift from interest rates to purchasing power. Because government funding through monetary creation doesn't eliminate costs, it transfers them. The cost doesn't show up immediately as a crash. It shows up gradually, through dilution, through a slow erosion of what money can buy. This is why calm headlines are misleading. Low volatility achieved through intervention is not stability, it is suppression. And suppressed systems don't heal. They accumulate pressure. When that pressure finally releases, it does so violently. We've seen this pattern repeatedly across history. Governments that struggle to fund themselves turn to monetary authorities. Monetary authorities expand balance sheets. Confidence weakens. Savers look for protection. Real assets outperform paper claims. The cycle repeats. And right now the signals are aligning. If the economy were genuinely strong, there would be no need for emergency liquidity. If the system were self-sustaining, debt auctions would clear without assistance. If the structure were sound, the central bank could step away. But it can't. And that's the real story behind the numbers. For everyday people, this matters far more than market jargon. Because you don't need hyperinflation for damage to occur. You don't need a currency collapse for losses to be real. A steady decline in purchasing power is enough. If your savings buy less every year, that is a loss, even if the balance doesn't change. If your retirement income lags behind rising costs, that gap becomes permanent. If stability is maintained only through printing and intervention, the price is paid quietly over time. This is why informed capital is already repositioning. You see it in demand for tangible stores of value. You see it in long-term asset allocation shifts. You see it in behavior, not headlines. The smart money isn't waiting for an official announcement. It moves before confidence breaks, not after. And that doesn't mean panic, it means preparation. Understanding what's happening now allows people to make decisions deliberately, not emotionally. It allows them to diversify risk, protect purchasing power, and avoid being caught off guard when narratives change. Because narratives always change after the math forces them to. The Treasury market is not collapsing today, but it is sending warnings. And warnings ignored don't disappear, they compound. This moment isn't about fear, it's about clarity. About recognizing that systems built on constant refinancing and intervention eventually reach limits. About understanding that when central banks are trapped, the consequences don't stay contained within balance sheets. They reach households, they reach savings, they reach real life. And the sooner people understand that, the more options they have. That's the reality behind the calm language, the technical explanations, and the reassuring headlines. The structure is under strain, intervention is accelerating, and the cost will not be evenly distributed. It never is. The uncomfortable truth is that systems don't fail all at once. They fail quietly, then suddenly. First, the language changes, then the tools change, then the justifications change, and only at the very end do the outcomes become impossible to ignore. Right now, we are firmly in that middle phase, where actions are escalating, but explanations are still designed to sound routine. When officials say markets are functioning smoothly, what they really mean is that they are being actively managed. Smoothness achieved through intervention is not the same as resilience. Resilience means a system can absorb stress without extraordinary support. What we are seeing now is a system that cannot tolerate even modest tightening without requiring immediate relief. This is why the balance sheet matters so much. It is not just a ledger of assets and liabilities, it is a map of dependency. Every time the central bank steps in, it teaches the market to rely on it more. Every time it pulls back and something breaks, it confirms that reliance. Over time, the feedback loop becomes permanent. And once that happens, there are only two paths left. Either intervention continues indefinitely, or the system is allowed to reset violently. Historically, policymakers always choose the first option for as long as possible, because the second option is politically and socially unbearable in the short term. But extending the timeline does not reduce the cost. It concentrates it. This is where the refinancing wall becomes critical. Rolling over massive amounts of debt at higher rates is not a theoretical challenge. It is happening in real time. Every auction is a test of confidence. Every bid-to-cover ratio is a signal. And when demand weakens, the pressure shifts upward toward whoever must step in to prevent failure. That is why short-term measures matter more than they appear. They are not isolated decisions. They are precedents. Once the door is opened, it becomes easier to walk through it again, and again, and again. People often ask why inflation doesn't immediately explode if money creation is such a problem. The answer is timing and transmission. New liquidity doesn't hit consumers first. It moves through financial channels, asset markets, and government funding mechanisms. It suppresses yields, it props up prices, it distorts signals. Only later does it show up where people feel it most, in housing costs, food prices, energy bills, insurance premiums, and everyday necessities. By the time it becomes obvious, the damage is already embedded. This is why focusing solely on headline inflation misses the point. The real issue is purchasing power over time. If the currency consistently buys less, stability is an illusion. You can't measure security by nominal numbers alone. And that brings us to trust. Currencies don't collapse because of spreadsheets. They collapse because confidence erodes. When people begin to believe that money is being created not as an emergency measure, but as a permanent funding mechanism, behavior changes. Saving becomes less attractive. Speculation increases. Real assets gain favor. Velocity rises. None of this requires panic, it only requires awareness. Right now, trust is being tested quietly, not through dramatic announcements, but through necessity-driven actions. When the central bank must support government financing to prevent instability, that is a message. When tightening becomes impossible without breaking markets, that is a message. When balance sheets stop shrinking and start growing again, that is a message. They are all saying the same thing. The system is more fragile than it appears. For individuals, this doesn't mean abandoning the financial system or expecting overnight collapse. It means understanding risk asymmetry. The upside of doing nothing is limited. The downside of being unprepared is significant. Protecting purchasing power is not about timing a crash. It's about recognizing trends and positioning accordingly. It's about diversification beyond paper promises. It's about understanding that monetary policy affects savers differently than borrowers, and that those effects compound over time. History doesn't repeat perfectly, but it rhymes consistently. Periods of heavy debt, rising refinancing costs, declining external demand, and central bank intervention always end the same way. Not necessarily with chaos, but with a reset in relative values. That reset doesn't announce itself ahead of time. It shows up after the fact, once the groundwork has already been laid. And the groundwork is being laid now. So when you hear that volatility is low, ask why. When you hear that intervention is temporary, ask how long temporary has already lasted. When you hear that this time is different, ask what has actually changed. The math, or just the messaging. Because math always wins eventually. The Treasury market doesn't need fear to fail. It only needs arithmetic to keep working as it is. And arithmetic says that endlessly refinancing growing obligations at higher costs requires either ever-increasing demand or ever-increasing intervention. If demand doesn't return, intervention becomes the only option. And intervention always has a price. The price is not paid by institutions first. It is paid by currency holders, by savers, by retirees, by anyone whose wealth is stored in units that can be created at will. This is why paying attention now matters more than reacting later. Once policy responses become obvious, flexibility disappears, options narrow, decisions become reactive instead of strategic. Understanding the mechanics today gives you time. And time is the one asset policymakers are trying to buy with every intervention. The question is whether you use that time as well. Because the Treasury Ponzi does not break with an explosion. It breaks with a slow loss of confidence, masked by calm language and technical explanations. And by the time the language changes, the transfer has already happened. That is what is unfolding now, not tomorrow, not someday, now. And the people who recognize it early are not the ones panicking. They are the ones preparing quietly, while the headlines are still telling everyone else to relax. That is how this always works. And that is why this moment matters. Another layer of this story that rarely gets discussed is how quickly confidence can shift once incentives change. Markets don't need everyone to lose faith at the same time. They only need marginal buyers to step back. When the last reliable buyers hesitate, price discovery breaks, and authorities step in, not by choice, but by necessity. This is why central bank language has become so careful. Every word is calibrated to prevent questioning the system itself. Stability is emphasized, control is projected. But if control were absolute, reassurance would be unnecessary. You don't constantly defend something that is genuinely secure. What we are witnessing is a transition from a market-driven treasury system to a policy-driven one. That transition does not happen overnight. It happens incrementally through small adjustments that seem harmless in isolation. But when stacked together, they reveal a clear direction of travel. Once a government's borrowing costs can no longer be set by free demand, the currency becomes the shock absorber. Interest rates are capped, volatility is suppressed, and purchasing power quietly takes the hit. This is how debt-heavy systems survive longer than expected, but also how they weaken internally. It's important to understand that this is not about mismanagement by a single administration or decision maker. This is a structural outcome of decades of compounding obligations. Promises made long ago are colliding with demographics, slower growth, and rising costs. No policy tweak can reverse that overnight. That's why central banks find themselves trapped between two bad options. Tighten policy and risk immediate instability, or ease policy and guarantee long-term erosion. They consistently choose the option that delays pain, because delayed pain is politically survivable. Immediate pain is not. For markets, this creates a distorted reality. Prices no longer reflect risk honestly, signals are muted, warnings are postponed, but suppressed signals do not disappear, and they accumulate beneath the surface. The longer this continues, the more violent the eventual adjustment becomes. For households, the effect is more subtle, but just as real. The cost of living rises faster than incomes. Savings feel less secure even when balances look unchanged. Planning becomes harder because the future feels less predictable. These are not coincidences. They are downstream effects of monetary distortion. This is why focusing solely on short-term market movements misses the larger picture. The real story is not whether yields move a few basis points this week. It is whether the system can function without constant intervention next year and the year after that. So far, the answer appears to be no. Every attempt to normalize policy runs into the same wall. Liquidity dries up, stress emerges, support resumes. The pattern repeats. Each cycle leaves the system more dependent than before and the central bank with fewer tools that actually work. At some point, credibility becomes the final tool. When policy levers lose effectiveness, trust becomes the last line of defense. But trust cannot be printed, and it cannot be forced. It must be earned through restraint and consistency, both of which are becoming increasingly difficult. This is why real assets continue to play a quiet but important role in periods like this, not because of speculation, but because they exist outside the financial promises that are being stretched. They do not rely on someone else's ability to pay. They simply exist. Again, this is not about fear or extreme predictions. It is about understanding incentives. When the system rewards debt over saving, when intervention replaces discipline, and when dilution becomes the default solution, behavior adapts accordingly. People who recognize these dynamics early are not trying to time a collapse. They are trying to avoid being trapped by one. They diversify. They reduce reliance on any single outcome. They prioritize resilience over optimization. And that distinction matters, because when change finally becomes visible to everyone, it usually arrives faster than expected. The calm that precedes it is often mistaken for stability. In reality, it is the silence before repricing. The Treasury market does not need to fail spectacularly to change lives. It only needs to stop functioning as it once did. A gradual shift in how government debt is financed can reshape everything from currency values to social expectations. And those shifts tend to favor preparation over complacency. So the question is not whether this system can continue for a little longer. It probably can. The question is what the cost of that continuation will be and who will pay it. History suggests the answer is rarely the institutions that created the problem. It is almost always those who trusted the system without questioning its foundations. That is why paying attention now matters, not because disaster is guaranteed, but because ignoring structural warnings has never ended well. The Treasury Ponzi does not break loudly. It breaks quietly through erosion, normalization of intervention, and gradual acceptance of what once would have been unthinkable. And by the time the shift is undeniable, the opportunity to respond has already passed. That is the risk. That is the reality. And that is why this moment deserves far more attention than it is receiving.